Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, it's Monday. We got the markets back open, right? So what's going on? Well, we're actually down a little, down about 30 points on the Dow, down about 30 on the Nasdaq. Actually kind of flat, not doing a whole lot. Now, this market has really not done a whole lot for the last couple months. We went down a little, up a little, but we're pretty much where we were 2 months ago. As a matter of fact, we're exactly where we were 2 years ago. Now, what direction is the market headed? Well, my take on the market is that we're going to come down lower. Now, like I say, the S&P has been trading, well, we're trading right around 4130 right now. And every time we get above that 4150, the shorts start to pile on. They're starting to pile on and pushing it down again. I do expect we're going to get a big move eventually. Now, we're still above that 10-day moving average. So that is a positive sign for the bulls. Until we can get down below the 10-day moving average, maybe there's still some upward pressure on the market. But I think the market's going to start to come down. Now, one of the reasons is that we're coming into, well, the bad part of the year. There's actually two parts to the stock market year, the good part and the bad part. The good part runs from November 1st to May 1st. That's the good time. The bad time is from May 1st till November 1st. Now, if you take your money out from May 1st till November 1st and put it into a money market fund or put it into a bond, you will actually do almost twice as well as the S&P average over time. Now, it doesn't work every year, but it does work over time. Or if you took the last 20 years, you could almost double your rate of return if you just stayed in the S&P, or if you took your money out of the S&P from May 1st to November 1st. There's even a saying, sell in May and go away. We're coming into the bad part of the year. And now we've had a good rally off those October lows. We're up roughly 20% off of the lows. And now I think the bad part of the year starts May 1st, coming in about 2 weeks. Now, maybe they can push it a little bit higher before those 2 weeks play out, but it's coming May 1st. That's the bad part of the year. Well, we're going to start to go down, and I think we'll go back and retest those October lows. Once again, this is just my take on the market. I'm sure you've got a completely different take. All right, let's get over to the real estate market. Now, what's going on in the real estate market? Well, the housing market is still under pressure. We're down year over year. Now, what's interesting is that rents are down year over year. Now, of course, not in your area. Prices are still higher. Rents are still going up. But overall, on a national average, both of those numbers would be down year over year. Now, it's fascinating to me that rents are coming down. Rents are coming down pretty quickly in a lot of areas. For example, if you were in Houston, Texas, rents are down over 10%. And that creates a problem, right? So that creates a problem for the apartment owners, the people that own the apartment, the investors, if you will. There was a 3,000 unit apartment building in Houston, Texas that just got foreclosed on. Anyways, went back to the lender. Now, you see a lot of lenders have loans on these commercial loans, and these commercial loans are being sold off by the banks at a record pace. Why? Because, well, the banks see the writing on the wall. Look at, if you own commercial loan on a shopping center, you're in big trouble because 1 out of every 3 tenants are not paying their rent. So you're having trouble collecting the rents as a landlord. You can't pay your loan, and so the holder of that paper is in trouble. That will go into default, and well, they don't really want to own the shopping center. A lot of this commercial paper is owned by pension funds, owned by insurance companies, owned by the regional banks, and these would be things like shopping centers, like office buildings, but now it's spread into apartment buildings. Apartment buildings are really becoming a bad investment. Now, during the pandemic, a lot of investors piled money into apartment buildings because they saw the rents kept going up and up and up. But now the rents are going down, right? So the rents are starting to come down, and these apartments are now having vacancies. They're having eviction problems with people not paying their rent, so they have evictions. They have vacancy. The rents are going down. Well, what's going up? Well, the expenses. The expenses to run the apartment building is going up. but there's going to be a lot of, foreclosures on the apartment buildings. You see people in the units themselves, they're getting foreclosed upon by the landlords, but the landlords are getting foreclosed upon by the note holders. So people that hold this commercial paper, they're losing out. They're going to start to be underwater. And now this is going to create a lot of problems in the credit markets. The credit is starting to contract. Now, a lot of people don't think that can spill over to the housing market, but I think it can. And that's going to bring the housing market lower. The rents coming down are going to bring the housing market lower. Now, there's 500,000 to 1 million new units coming onto the marketplace this year. And that's in the rental market. That's in the apartment buildings. That's not in the houses. But in the houses, investors own about 30 million in homes that are owned by investors. And now these investors are seeing better opportunities elsewhere. So they want to get out of the landlord business, out of the housing market completely. Okay. So here's just a couple of examples, right? I got this one friend. Okay, so he lives in San Francisco. Now, San Francisco, he rents a 2-bedroom apartment. He's a young guy. He's got a roommate. So him and his roommate, they get a 2-bedroom apartment. Now, a year ago, actually about 14 months ago, they just signed a lease for a 2-bedroom apartment. Okay, so they signed that lease. They were paying $4,300 a month, but they got 2 months free rent. Okay, so $4,300 a month. And the 2 months free rent if they signed a 12-month lease. So they signed a 12-month lease and they got 2 months free, and now it's been 14 months. All right, so that same unit in the same apartment building this year is going for $3,900. So it went from $4,300 down to $3,900, down about 10%. All right, instead of 2 months free rent, though, they're giving 3 months free rent. So that's a bigger bonus. Okay, so the rents in San Francisco are dropping by over 10% in the year. The rents are coming down. Well, Mike, that's apartments. What about houses? All right, well, let's talk about a house. Okay, so my next door neighbor, they're very wealthy people. They work for Facebook. Both of them work for Facebook, the husband and the wife. And they bought a house up in the Los Altos Hills, and they decided to hold on to their house that's right next door to me. And this was what they felt would be a good investment over time. Now, they could have sold that house for $2.5 million. $2.5 million. Okay. And I told them that I thought they should sell, but they decided to rent it out. Okay. And they got $5,500 a month rent. $5,500 a month rent. Okay. And that person stayed there for a year. Okay. Now, what's happened to the cost of the house for the year? Well, it went from about $2.5 million down to about $2 million. Okay. So they lost $500,000, but they brought in about $60,000 in rent. Okay. So they lost $500,000, but they brought in $60,000. Okay. But now they're keeping it as a rental. I go, why aren't you selling it now? Well, Mike, it's only worth $2 million now. Billy Bob down the street, he got 2.8. We'd be a fool to sell at this price. Well, I have a different take on that, but okay, so they're not going to sell. So they got the place for rent now. Now, last year they got $5,500 for the place. Right now, they started it at $5,000. Okay, no takers. They've now dropped it down to $4,500. That's $1,000 a month less than they got a year ago. But the place is still vacant. And I like it vacant because it makes it so quiet around here. No neighbors, I mean, it's quiet. I like that. But they're at $4,500 and nobody's come to rent the place yet. We'll see. I expect that it'll rent for about that, but their rent has dropped by $1,000 just from last year, and the price of the house has gone down by $500,000. Now look at, if they had sold for $2.5 million, they could have got out at. Now, they might have got out close to Billy Bob. Billy Bob got out at 2.8, but okay, so they could have got out at 2.5. Now, if they had taken that money and put it into a well, just a bond, a treasury bond. They're paying about, what, 5%? Well, boy, that would have brought them in $125,000 over the last year, right? But they wanted to rent it out, and they did get $60,000, but the value of the home dropped by $500,000. So the prices are going down. So my point is that investors want out. And there's no new investors coming in. Look, you would be crazy to come into this market, buy a home, let's say it's $1 million, right? Buy a home at $1 million. Okay, your property taxes on that are going to be $1,000 a month. Now, what could you rent $1 million house for? Maybe you get $3,000. Let's call it $3,000, but property tax are going to take away $1,000 of that. So you'd get $2,000, okay, $2,000, $24,000 a year. But you could take that $1 million and just get a bond, 5%, you'd be bringing in $50,000, and you wouldn't have the downside risk that I say is going to happen to the housing market. The housing market is going to feel a lot of pain. I think the pain's just getting started, and people don't see it that way. People see it, hey, we're in the recovery mode. We're going to get back up to those prices that Billy Bob got. Matter of fact, we're going to become the new Billy Bob because it's going to go above where he got out at. Now, I don't see it that way. Now, of course, your area is different, and every area is different, but your area is still at record highs and going higher. I get that. That happens in your area, but the national average is down year over year. On price, the national average is down year over year. On rentals, the investor, 30 million homes are owned by investors, are wanting to get out because they could do better just putting their money into the bond market at 5% paid by the government, right? So they could just sit on the couch, collect their money, wouldn't have to worry about the downward death spiral that's starting in housing. People think it's over. People think we've come down 13% off the highs, that this is the bottom. Everybody jump in. The water's warm. I don't see it that way. I see we're still in the death spiral. Now, nothing goes straight down. The stock market doesn't go straight down. Houses don't go straight down. So there'll be a month where it pops up and the news media will come out and they'll go, look at it. Mortgage rates have dropped down by 1/4 point. Everybody's jumping in. Here's the numbers to prove it. 1 month doesn't make a trend. The trend is downward, and the trend is going to remain downward for several years to come. So a lot of these investors, they're running for cover, right? They're running for cover because, well, during COVID, a lot of the people were not able to rent their houses, to collect the rent. They had them rented, but you see, people didn't have to pay the rent during the pandemic, right? They didn't have to pay rent because of the pandemic, so they weren't able to collect the rent. So these landlords, they weren't just being landlords. They had property rights, but their property rights were no longer being protected. People with mortgages did not have to pay the mortgage. They went on forbearance. Now, this is not good for the investor, right? The investor, they invest money and they expect to be able to get paid. But if you can't get paid, the investor doesn't want to be a landlord anymore. And I don't blame the landlords. They want out. They want out. So they got 30 million homes. Now, of course, none of these are in your area because there's no rental homes in your area. Everybody owns. I get that. And some areas are like that. But a lot of areas have rental properties where the landlord wants out, so he's going to put this on the market when his tenant's lease comes up. Now, there could be some people, like my next door neighbor, when the lease is up, they don't want to sell because they're below the price Billy Bob got out at. So they want to wait for it to go back up to get Billy Bob price, even though their rent that they're asking now is down $1,000, and they could just take that $2 million if they sold now, put it into bonds, and get, well, they get what, $100,000 bringing in when they're only going to be collecting $50,000 rent. So there's a $50,000 disparity there between the rent they collect or the money they could collect on a bond, but they think the price is going to go up from here. They think the $2 million house is going to become $3 million. It's going to go above the price that Billy Bob got out of it. It's just not my take on the market. My take on the market, we're still in a death spiral. Going to take a year or two to play out. Be patient. Sit back. Get some popcorn. Watch the show. It's like a good horror flick. I'm telling you, it's getting exciting. Anyways, I'm Tall Mike. If you like this stuff, give me the thumbs up. Why not? It's Monday. Hit that subscribe button. I want to talk to you later in the week. I got some good stuff coming up. Bye-bye now.